I'm Wong Ning, and welcome to our BFM Personal Finance webinars. Today's topic, of course, is property still an asset class to consider in this post-COVID-19 era? Because I think even before COVID-19 pandemic hit our shores, we already know the Malaysian property market was rather sluggish with high unsold inventory in both the commercial and residential space. But the question, of course, is does this create an opportunity to relook at property as an asset class? Because are there bargains around with recovery around the corner? So to help us answer that question, while also addressing the risks, we have with us Rajen Devadason, licensed financial planner and CEO of RD WealthCreation, and also Michael Gay, who is a board member of FIABCI, the International Real Estate Federation, and senior partner of Rain and Hone International Zaki and Partners Sendirian Berhad. Good afternoon to all of y'all. And also, of course, not forgetting Malek Ali, founder of BFM and filife. Now, let's start quickly because we have quite a lot to go through. So the first question I have is actually for Michael, who is a frequent commentator and long-time property consultant. What is the outlook of the property market? And let's take some time to pick his brains, but focus on the Klang Valley. Michael, I think you need to unmute yourself first.
Hi, BFM. Thank you for having me.
So like I said, Michael, what is the outlook of the Klang Valley property market? Let's start with the residential first.
In 2019, the home ownership campaign, the developers were having a very good run actually. The performance was quite good until December. The secondary market was also moving. Only in the Q1 of 2020 did lose momentum because of the stopping of the homeownership campaign in December, and then we had some political issues that came up, and then Chinese New Year, and then the COVID hit us. So it was a Q1, Q2 was rather tumultuous in nature.
Yes, what is the outlook? That's the most important thing, right? What can we expect going forward?
Moving forward, the corona, the C19, will live together with us in the next 18 months, I think. And it's not about post-COVID, it's about living together with COVID and slightly moving forward. The auctions started last year, 2019, will roll into now 2020. Yes, in the auction market, we can find property up to more than 20-30% down of the original value. Auction market only. Developers market is still a developers market. The prices are still being offered by the developers quite firm, and then with some niceties to ease the purchase. Banks are still very keen to release loans, to give out loans to very easy on first-time home buyer, and people who qualify.
Does it matter whether it is landed residential or let's say high-end, high-rise residential?
Both actually, both. I find that even the properties in the new projects, even 3 to 5 million, that will take us the last 2 months. The market is not dead. The market is active. Activity, booking and activities were there in the last 2 quarters. Only in June, banks were very active in processing the loans, and then the lawyers were doing the conveyancing. It was an active market in the first half of 2020. A lot of houses, residential houses in Klang Valley are yes, people have lost their job and their businesses. I do hear of weakening of property prices to the unfortunate events that turned in 2020. But other than those things, the market, how to say,
is relatively stable.
It is, the prices are weakening. Stability, because our banks went in with moratorium. So this year, you won't hear of mass auctions this year because of even the current moratorium, loan moratorium, and the selective moratorium. I think the banks are doing a very, very good job. I must comment, Bank Negara did a very good job in preserving the property as an asset class, and do not make property market lose a lot of its value.
But what about the commercial space, Michael? Because we know that there's like 108 million square feet of office space in Klang Valley, KL Central actually, but the occupancy is only 70%, and this is even before TRX and Merdeka 118 buildings are launched. So with the work from home becoming a reality for many of us, is commercial facing a structural decline?
Location is everything. Location along MR, the lines, the current line, the future lines, and the incoming, the ECRL from Kelantan all the way down to Klang, and the moving forwards from the high-speed train that will rejuvenate Malacca, Seremban, all the way down to Johor. These are the future hotspots. The dynamics of the property market is very much dependent on current hotspots, the trains, and the future hotspots. It is not what you think, and I think you must look at the maps, and from what I see, our government is speed tracking these infrastructure approvals. Yeah, there's a lot of signings. So all the way from Klang Valley to Johor will be stimulated, because anything 5 kilometers of a future station will do well, will become a hotspot.
Now, Rajen, I want to ask you your observations, right? Do you see any other dispennable property trends as a result of COVID-19 that will become long-term realities? Because I think we see that already in New York, for example. Sales in Manhattan are very soft, but prices actually have gone up amazingly, 40% in some of the nearby boroughs like Greenwich and Winchester and even Brooklyn. Do you see this trend happening here, especially since working from home will become a reality and you don't need that space anymore? So people moving to Rawang or even your neck of the woods, Ramban.
Thanks, Shou. In my opinion, the New York, the New Jersey phenomenon basically revolves around gentrification. So it's really good in terms of taking places that have done very, very badly and then causing some level of uplift. However, in the last week or so, a relatively new term has arisen with regard to the economic recovery. You know, usually when we go through a crisis, people say that they expect a V-shaped recovery. And then because COVID-19 continues to cast its pall upon all of us, some people who are very, very depressed would say we're stuck in an L, which is really depressing. Others would say it's a U. But only in the last week, I've come across this term, which is a K-shaped recovery, which I thought was so clever. And so with the K-shaped recovery, the market dropped, and then we're going to have strength in for some people and weakness for others. And the truth of the matter is, given the demographic that listens to BFM, those of us who are involved in investing, in thinking, in staying economically active, we actually are going to experience the top leg of the K. But there's going to be a structural move to extreme poverty for a lot of people, not just in Malaysia, but around the world. And so I think it's going to be a two-speed economy. I don't mean to be terribly depressing, but because I'm speaking from the perspective of a licensed financial planner, and also like Michael, I'm a CFP, a certified financial planner. The issue about financial planning is that it is the process of meeting your life goals through the proper management of your finances. And this is valid for everyone, those who are at the top end of the K recovery, and especially for those who are going to end up with problems. So I've got a lot more to say, but right now, just to answer your question quickly so we can move on. In our earlier discussion, you used a phrase that I thought was fantastic, a hollowing out of the cities. I love that phrase. And I think you're absolutely right. One of the big plus points of the MCO for many of us is that we actually started to get used to working from home. And as we begin to move back into the cities, as we go back to work, etc., we're finding that, maybe we don't need to turn up in the office in KL or PJ or whatever, 5 or 6 days a week. Maybe we can get by with just 2 or 3 days. And as a result of that, I think net, there's actually going to be a reduction in the expected recovery in office space. Later on, I actually want to spend quite a lot of time talking about the value of investing in REITs. I'm a huge REIT fan, but not all REITs are created equal. Many of us know that the retail sector is dying. And so retail REITs right now, maybe not the best place to put your money in. But who is the wealthiest person on the planet? Jeff Bezos. Why? Because of Amazon. Why? Because all of us are busy clicking. And therefore, logistics, warehousing REITs are doing incredibly well. But I think to benefit from the macro trends in investing, we need to move beyond the narrow focus of just the Klang Valley, the narrow focus of just Malaysia. At the very least, look at Southeast Asia, then broaden out to the Pacific, and then look globally. But in general, I think for the many of us who are fortunate to be at the top end of the K, the recovery bit, this weakness is going to lay the seeds or plant the seeds for us creating great wealth in the decades ahead.
Okay, we'll definitely come back to a more detailed discussion on REITs as an alternative investment to property. But I want to ask Michael this question. Rajen's kind of painted somewhat of a mixed future for us, especially in the property sector. But really for it to recover, right, Michael, what do we need to see? What are the catalysts for property prices to actually appreciate rather than in the last 1 or 2 years, it's been relatively stagnant?
Recover? Do Malaysians wish to see exorbitant property prices? Do Malaysians wish to see Malaysians borrow 2-generation loans? Do Malaysians wish to see property prices that needs to be guaranteed by 2-3% or 2-generation loan? I don't think so. Malaysia has only 32 million population. Klang Valley, 5 to 7, Greater Selangor, only. The Penang is only 1.8 million pax. What about Seremban? What about Johor? We are an underpopulated country. In fact, we are one of the lowest populated country in the whole Asia, other than Brunei. Philippines, 70 over million. Thailand, Indonesia, 250 million. We are I do find that our population is relative, and there is up to how much a house can be and up to the household can afford. I don't think the house price will go up forever. And then it's about location and the quality and up to the capability of purchase by the individual family. So when is the right time to buy? It depends on you. If the person is able, capable, and will and happy with the property to purchase or the current, upgrading, buying for retirement, buying for first home, because of our Ministry of Finances, so many sweeteners in the market, it's the right time to buy. And the market is very diverse from the secondary market, that means secondary market, and the developers market. There are many offerings. So I don't subscribe to the fact that the prices must be high again and everybody goes up to chase the property market.
But I guess then it goes back to asking yourself, why are you buying a property? But the conversation, I think, is if you were looking at it from an investment perspective. So if you're out there to buy your first home, maybe there are still bargains out there. But anyway, for those who join us this afternoon, we are asking if property is still a good asset in this pandemic era. And to help us do that is Rajen Devadason, licensed financial planner and CEO of RD WealthCreation, and Michael Gay, board member of FIABCI, the International Real Estate Federation, and senior partner of Rain and Horn International Zaki and Partners Sendirian Berhad. We also have Malek Ali, founder of BFM and filife, joining us. Now, in the meantime, do let us know if you have any questions, chime in, because we want to answer them, as we want these conversations to be as interactive as possible. But Rajen, I want to go back to you, because we spent quite a bit of time discussing where property prices are heading. Is it going up? Is it going down, or not moving at all? But I want you to help us understand how we should look at property as an investment. Because if I'm not wrong, it can generate two kinds of returns, right? So capital appreciation when it's sold, if you are lucky enough to sell it, and also yield. Can you explain it to us, the difference, please?
Sure. I'm happy to give you answers that are based on textbook theory, also from my practice. But maybe what's of greatest use to listeners is for me to start and share about my own fairly dismal personal experience with brick and mortar investments. I am one of the few people I know of who actually managed to buy brick and mortar property in Damansara Heights, to hold it for ages and still end up losing money. So it's just very, very depressing.
Sorry, I shouldn't laugh, but I shouldn't have laughed.
No, I'm laughing as well. But thankfully, it hasn't been all bad news. I actually choose to live in Seremban. And for those of you who find that, you work in the Klang Valley, and you, because of the whole shift to work from home, you find that you don't actually need to be physically in the Klang Valley office. May I strongly suggest that you consider coming down to Seremban, driving around, and checking out a lot of our empty houses. Now is a great time to actually buy. Because Michael mentioned something that I really should have thought of, but I didn't just now. I've thought about it in the past, I've written about it, but the last couple of days, it just never occurred to me. The current government is fast-tracking the high-speed rail link with Singapore. I am so happy. And it's very, very important to understand that connecting our two countries is absolutely crucial for both countries. And certainly as you connect Singapore with KL, let's say, Malacca, which is where I was born, Seremban, which is where I will live, we will definitely benefit. We will definitely thrive. So I guess if there are potential property investors in KL who are thinking of buying one piece of property in the Klang Valley, maybe what you may want to do is, especially when the lelong period starts up next year, after all the moratoria end, maybe you want to consider buying really good pieces of property in Malacca and in Seremban, holding, and if you're going to do that, what you want to do is to buy brick and mortar. Now, Shou, you were talking about the two forms of benefits that we get from brick and mortar investments. Capital gains, absolutely right, and also your yield. Now, normally when people make a decision about what kind of property to buy, in the Malaysian context, buying brick and mortar landed is very, very expensive. Plus, the rental yield is quite horrific. On residential, I think it's quite normal for us to end up with rental yields in the 1% to 2% range, which all of us used to sneer at until Bank Negara cut our overnight policy rate 4 times this year, down to 1.75%. Now, my own speculation, okay, I don't have any inside track on this, but I wouldn't be surprised if in the next 10 to 12 months, Malaysia's OPR drops as low as 1%, as the regulator works very, very hard to try and jumpstart a flagging economy. Malaysia's property market has actually been weak for many years now. It's not a 1 or 2 year thing. It's not a COVID-19 issue. I think over the last 4 or 5 years, it's been horrendous. And if you track the macro trends, what you will realize is when oil prices started to come down, then Malaysia, as the sole net exporter of fossil fuels in Malaysia, fossil fuels would cover oil, it'll cover natural gas, it'll cover coal. Coal's very small in Malaysia. Thankfully, we've got plenty of gas in Parliament and outside, real gas as well that we sell to the world. And we've also got oil. So as oil prices start to rise again, I think the structural changes that COVID-19 has brought about will actually put a cap. I would be very, very surprised if we come back to oil at $70 or $80 a barrel. I'd like to see it for the sake of Malaysia, but I don't see it happening. I think Petronas right now is really hoping and praying that we get back to 50 or 60. I have quite a few clients in the oil and gas sector, both in Malaysia and around the world, and it's been rough. It's been very, very tough. And so if the structural changes result in oil staying at 30 or 40, Malaysia will do very, very badly. If oil prices start to rise again and we get stability at about 50 or 60, then I think Petronas will start to do better. Petronas's satellite companies, the companies that actually take care of Petronas, will do well, and there will be a trickle-down effect. In terms of buying brick and mortar, people need to keep their jobs. They need to be able to earn money. They need to be able to go to the bank. They need to be able to borrow. And hopefully, they need to be able to pay it off quickly. Coming back to capital gains and yield, new investors in property are very often attracted to buying condos because the upfront yield, the rental yield, is much higher than you can get on landed. Plus, the pieces of property are cheaper. But what normally happens is, unless you've got a fabulous condo developer, after 2 or 3 years, your condo will start to look aged. Some other developer will put up a condo right in front of you, killing the view. And then the next round, when you actually need to get tenants in, you're going to find that you have to drop the rental. So it's a very painful deal. But for upfront yield, you buy condos. For long-term capital gains, you buy landed. I hope that helps.
Yes, thank you, Rajen. But Michael, I want to ask you, how should we calculate yield? Because I think many of us think of it as an absolute number. But actually, what's also really important is to bear in mind all the costs and expenses that come with owning a property. So, I mean, interest cost is one of them because, you know, not all of us are so wealthy to be able to buy it cash. But what are the other costs that we should consider between, let's say, landed residential, high-rise residential, and even commercial space? Because things like management fees, for example.
The initial purchase of the property is all these taxes, lawyer fees, all these fees. And then in the, for commercial property, if it's in a complex, there are management fees for maintenance. If you on a strata property, residential, there are other strata fees to look at. How to calculate yield? Yield is just return, annualized return, divided by the capital purchase. If you make a bigger purchase, 1 to 2 million, then if your rent is lower, your yield goes down 1% also. So normally, residential, a good yield is 2, 3, less than 5% is considered very good already. You know, it's
what
not
about commercial?
Commercial 5, 6, 7, 8% is good.
Can you still get this in this kind of market considering the soft conditions? Because I mean, I'm just doing a very kind of my own form of a channel check. But when I drive around Taman Tun near Menara Ken, where our office is, we do see a fair bit of shop houses with for rent and for sale signs, right? So is that indicated that yields will come under pressure going forward?
Not going forward. Last year already, yields are under pressure. And COVID is going to be with us, co-live with us in the next 18 months. So we are living in a lower yield environment.
So I suppose the historical trends of 6% and above are probably going to be softer in the future then.
Definitely.
Or commercial. Okay, and the other thing, gentlemen, I want to discuss is, you know, many of us think that the house that we buy is an investment. But is it truly an investment? Because when you think about it, it generates no returns until one day when you sell it, if at all you sell it. And for many of us, it's not viable because that's our home. So is it a form of trapped equity? Rajen, what do you think? Because I want people to really look at property as an asset class, as an investment. I mean, how should we differentiate it?
We have many levels of needs as human beings. And not everything is about investing. Go back to the basic definition of financial planning, the process of meeting your life goals through the proper management of your finances. I advocate that my clients buy as nice a home as they can manage, but without overextending themselves. I actually give advice that some of my peers disagree with, which is perfectly all right. But I think it is wise to actually use as much of your EPF account 2 money to pay down your home mortgage as fast as you can. Now, this is actually going to trigger a lot of comments, a lot of questions. People will say, no, EPF paying me so much and bank loan is so cheap and then I can make differential. And I understand, I can run the numbers. But the moment you pay off your own home and you own it, as opposed to you and the bank, something changes inside of you. And the level of risk that you are experiencing for the rest of your life dramatically comes down. One of the best American mutual fund investors of all time was Peter Lynch. In the, I think, late 80s to 90s, Peter Lynch wrote 2 books for adults and 1 book for children. One was One Up on Wall Street. The other one was Beating the Street. These were the adult books. And then for kids, he came out with a book called Learn to Earn. Peter Lynch, who understood his proven capacity to compound money at a great rate, actually advocated in whichever of his first adult books it was, that people should go and buy their own home. They're unlikely to lose money on it, but it is the sense of owning it. And so I don't like the term, what did you say? Trapped equity, right?
Trapped equity.
I don't think so. But I do believe that if your external investments are like, 100,000 ringgit, and then you're sitting on a 3 million ringgit mansion and that's all you're doing, then I think it's very unwise. I think what you should do is come to Seremban, buy a house in Seremban and rent out your 3 million ringgit mansion. Did you know what I mean? So
yeah,
when it comes
it's
to
a form of a lazy asset, right? That's your point in a way.
it is, but we live there and we should get as much joy from it as we can. But I think it is very, very important for us to distinguish between the home that we live in and our property investments. And so whether our property investments are brick and mortar investments only, or whether they are REIT investments only, or for most people, there will be a combination of both, that investment should be part of a broadly diversified portfolio. And the portfolio should be diversified, in my opinion, across different asset classes, across as broad a geographic set of regions as possible, ideally across the entire planet. And especially if you have a durian runto situation where you end up with 2 million or 10 million on your lap suddenly, don't just go and plonk everything into risk-on investments. Take some time, not a long time, but if you have a 30-year investment horizon, then take 2 years, 3 years, 5 years to gradually bleed your money across from liquid, low-risk investments into the higher risk asset classes. Things like equities, things like investment real estate, and things like alternative investments. For my clients, I put them into commodities. So I know I'm giving a very broad answer, but I hope this helped. But I do not believe that the home that you live in is wasted. I do think, however, you got to learn how to exercise delayed gratification so that you live modestly, but you invest large. Because if you do that, down the road, you'll be able to live big and give big.
So Michael, do you have anything to add, please?
I like your question. I like your angle of trap equity, and I like to say that, and I wish to say that investing in a home is a very important aspect of building up a family. There's no monetary value can come when the people have a satisfaction, that they are staying in their own home and having buying a home early, and at the age of retirement, you are staying in a debt-free home. It is an ultimate achievement in financial planning where you have no debt or lesser debt, but the asset is with the current, you can walk into private banking, you can walk into preferred banking, you can walk into any bank, you can get the leverage on your property. There's no such thing as debt trap equity. A lot of people enjoy, like for example, they move to the Klang Valley and say, the KLCC area, and say, I love the Twin Tower. Just by looking at the Twin Tower every day and night, I feel like a multi-millionaire. You know, it's just the view that from your balcony that's also very, very important. So these are the intangibles that it's very hard to calculate, I like your question, but I have to counter with the intangibles that you reply. Malek.
Yeah. I just have an example of how to untrap your equity. Recently, when the market crashed, I actually did a refinance of my home loan, my own home loan. And I did the opposite of what Rajen did. Instead of taking from account 2 and paying off my mortgage, I increased my mortgage to invest in equities. So so there we are. So I think I've untrapped it. For better or for worse, we'll see.
Well, Malek, no one's going to fault you. I mean, you are like a super successful, extremely young-looking multimillionaire.
No.
And what you did, actually, that particular ride, to take risk at the right time, to understand the market, you got to admit, you are not your stereotypical investor. You know stuff. And on top of that, I believe you actually have assets set aside. So that if anything were to go wrong, you'd be fine. I'm assuming, Shouning, sorry, but I'm very curious. I want to find out about this. When you went into the equity market, did you go in straight, or did you put loan upon loan by going on margin?
So when the markets tanked 30%, I went on margin. I didn't have that much cash. I mean, I've actually used up my cash as the markets went down. I bought in at -10, -20, and at -30, I ran out of cash, right? So then I said, okay, there is still fantastic value here. So I went in with margin, right? And then what I did was then to take my time to refinance my property to get the best interest rate. I think it's about 1.5%, and to pay down that margin. But I've locked in already the equity at -30%. By
Wonderful. Okay.
So,
which means that the yield that you will get on the dividends from some of those stocks will hold you in very good stead. But can I strongly suggest that you get off margin as fast as you can?
Done.
Cool.
All done. It's all paid down. So it's all good.
Okay, what Malek has done is not for the average investor.
Please don't.
Yeah.
So I think the average entrepreneur who starts the most successful radio station in Malaysia and then starts an insurance company, by all means, if that's who you are.
Yes. But caveat emptor, please.
Complete caveat. It was just meant to talk about trap equity, actually, and how there are ways and means of untrapping it. I think for example, in Singapore, there's a lot of conversation about people who are asset rich, cash poor. And the reason being is because they are sitting on, property, they are staying in properties which are, become multi-million-dollar homes in Singapore dollars. But they have very little cash, right? There's very little income coming in. I think that's the conundrum that I think somewhere like Singapore has a problem. But I'm sure it's with some retirees in Malaysia as well.
Yeah. Very true.
And
can I address that? Because this is actually helpful to people.
Yes, please.
Regardless of whether you live in Malaysia or Singapore or anywhere else in the world, if you're sitting on lots of pieces of property, which you think a good agent can actually sell, and you're having trouble actually getting proper tenants, maybe what you should do is actually liquidate some of those pieces of property, because you yourself or your local coterie of agents are unable to get you good tenants. And if you want to stay inside the investment real estate space, then what you do is you take that trapped cash, you sell, you raise some money, you cash up your emergency buffer fund, your cushion account, your reserve account. You put some of the money into a good portfolio of dividend-paying stocks or into dividend-yielding funds, and then buy lots and lots of REITs, hopefully diversified as widely as you possibly can, so that you still enjoy rental, but you no longer need to crack your head trying to figure out how to deal with broken toilets in the middle of the night. And also, you're staying in your lane in that space. It's still investment real estate, but you're basically giving up some of your future potential capital gains for a nice steady flow of effectively rental.
Okay, at this point also, Rajen, I want to introduce this term that I think many Malaysians fortunately have never experienced, and that is negative equity. So can you tell us what that means and why is it important? And then is it a possibility for us in this day and age?
I have come across the term negative equity when talking to family members and friends in Australia. I believe tax accountants in Australia, bankers in Australia, they have a tendency to tell people, you know, negative equity is very, very good because it reduces the taxes that you have to pay, etc. Could it happen in Malaysia? I guess it could if we actually change our tax code. Should it happen in Malaysia? I certainly hope not. I am becoming very, very worried. I'm not deflecting your question, but I think it actually leads on to a far more important issue. The entire world is going through a period of structurally low interest rates. Japan and Europe are running at negative interest rates. Donald Trump has been harassing Jerome Powell, chairman of the US Fed, for a long time, trying to get the Fed to go to negative rates. America already has negative real rates, but not nominal rates. And the equivalent of the Malaysian OPR, the overnight policy rate, is the US federal funds rate. And that is currently running at 0 to 0.25%, effectively as low as you can go as long as you have a proper floor and you don't go digging through the floor. In Malaysia, I think I shared earlier, our OPR is at 1.75%. Our FD rates, which is effectively our risk-free rate, is, say, the 1 month FD for different banks will, I think, range between 1.4 and 2%. So the midpoint, interestingly enough, is the OPR. If I'm right, and if more interest rate cuts are pending, I don't see Malaysia's OPR dropping below 1 percentage point inside the next year. And then hopefully what we'll do is we'll hold steady, and then hopefully the economy will pick up, and then we'll start getting embedded inflation, and Bank Negara will be justified in raising our interest rates. Because right now retirees are crying. Many retirees who have been retired for a long time remember the Asian financial crisis of 1997, 1998, when it was possible to get fixed deposits of 10%. Wonderful. And then in the intervening years, FD rates dropped to 5%, to 3%. They were at 3% end of last year. And then this year, cut after cut after cut. Now, I talked about the importance of building diversified portfolios spanning 3 asset classes, 4 asset classes, 5 asset classes, based on a very valuable resource, a free resource, by the way, that all of us can gain access to online, published by wealth management company Capgemini, is the annually published WWR, the World Wealth Report. Not every year, but in most years in the World Wealth Report, there is an analysis done by Capgemini on how the world's wealthiest people invest their money. And that particular table, which I eyeball every year, looks at 5 different asset classes: cash, fixed income, meaning bonds, equities, investment real estate, not the home you live in, okay, but other investment real estate, which can be REITs, and in my book can also be brick and mortar investments, and then alternative investments, which cover all kinds of things like derivatives, structured products, hedge funds, foreign currency, and my favorite of that full set would be commodities. Now, textbook, when interest rates go up, of the 5 asset classes, 2 of them come down in value. Bonds fall, so bonds drop, and investment real estate, REITs, drop. But when interest rates come down, bond prices rise, REIT prices rise. If I am correct in believing that Malaysian interest rates can still fall at least another 75 basis points, then that you must always err on the side of high quality. Buy the very best bonds you can, buy the very best REITs that you possibly can, but take advantage of this very clear interest rate shift. Now, the time will come when interest rates start to rise again. I'm a licensed financial planner. My principal financial planning company is Manulife Investment Management Malaysia Berhad. Manulife is a global group headquartered in Toronto. The global view is what we're telling all our clients around the world is lower for longer. That is our view, lower for longer, meaning we expect interest rates to stay low, I think, for at least 3 years. So because of that, wise investments in REITs and in bonds, I think can actually do you, can be beneficial. Having said that, interest rates never stay static for long. Eventually, the time will come when interest rates start to go up. When they do, you don't want to be trapped with all your money in bonds and REITs. You want to make sure that you diversify across other asset classes as well. So I'm not giving advice that is super easy to follow in the over the long haul, but certainly for now, in the short period, I think people can actually start looking at bonds and REITs to take advantage of the structural drop in interest rates.
Okay, for those who just joined us this afternoon, we are asking if property is still a good asset in the pandemic era. And to help us do that is Rajen Devadason, licensed financial planner and CEO of RD WealthCreation, and also Michael Gay, board member of FIABCI, the International Real Estate Federation, and senior partner of Rain and Horn International, Zaki and partner Sendiri Berhad. Not forgetting, we also have Malek Ali, who we have just found out is a bit of an the kid, founder of BFM and filife, joining us. Now, Michael, you heard what Rajen says, right? But I want to also bring up a point. At what point, if interest rates go up, does it then make sense for you or for someone like me to consider buying brick and mortar? So not just REITs, but brick and mortar. And what should I consider before making that very important decision? Because from what I gather, I mean, for you to actually make money out of this asset class, you need maybe cash or very low interest rates and patience, I think, because you need time.
Certainly, Shouning, buy property not only when
I think we have
the low interest rate like today, for low interest rate. Sorry. Yeah, but this low interest rate was not planned, or nobody could foresee this low interest rate regime we're having now. I would say buy property at your comfort rate, at our comfort rate and time. If you're younger and need a first home, buy a first home. If you are successful and moved forward, buy your ultimate home for the family, for the 3, 4 people. Upgrade. If you need to, not to say downgrade, if you need to, you have an empty nest and you need to sell the home and buy two smaller bungalow, smaller property, go ahead. Can you hear me? Can you hear me? Okay. So it's buying property is all about the situation we are now in our life, not about, oh, low interest rate, you must go and buy another one. We should have a reason, a good reason. The reason should be yourself, not somebody tell you to, I tell you to, or a developer tell you to, or a financial planner tell you to. It's up to you. Go and buy 3 property because you can get $500,000 or $1 million cashbacks, and then be a mortgage slave or instant millionaire, and then you maybe end up with ruin, financial ruin and with bankruptcy. So plan your purchase well. Don't buy on impulse. Don't buy on impulse, and do consult a lawyer, financial planner on your decisions. Don't only talk to your over-enthusiastic estate agent or developer friend who will tell you property price will forever go up and never go down. Yes, property is in a cycle, and Malaysia is only 30 million population. Gentlemen, will Malaysia's population be from 32 million to 60 million in the next 5 years? Do you think so?
No.
Rajen, do you think so? Mr.
No.
Malek, do you think so? Shou Ning, do you think so?
Unlikely.
Thank you. So the point that I'm trying to make is that we should buy property based on what we are capable, what we will use of it, and then what we will make out of it. Thank you.
Okay.
And
I'd
I
like
think
to
also,
add something.
yeah, please, Rajen.
It's crucial. Right now, we have very low interest rates. I still believe that interest rates can come down lower, but who am I? I could be wrong. Whatever it is, the rates are low. As a result of that, if you are going to go and buy property right now and to take advantage of the rates, I think one of the smartest things you can do is to actually go to the bank and try and structure, say, a conventional loan that is fixed rate, not variable rate. Because if rates are low, statistically speaking, they will go up. And what you don't want is to have a sudden increase in national inflation. And as a result of that, Bank Negara tries to cap the inflation by raising interest rates. And then you get really stuck. It'll wipe you out. Take advantage of the low rates right now, but get fixed rate mortgages.
Okay. I think the point is also, gentlemen, those old days where you could flip a property at a developer's launch and make a quick 10% are gone already, I'm pretty sure. But I think we need to move on to this discussion about alternatives to physical property, because we've talked about the downside, and one of them, of course, is liquidity. It's not always easy to sell the physical property when you want to. There could just be no buyers. So Rajen, what about, you mentioned REITs many times. How should we go about REIT investing?
I'm happy to talk about this and to wax eloquent, but I think Malek wanted to say something.
Sorry, yeah, no, there was just a question on FB on physical, last question on physical property before we move on to REITs, Shouting, sorry, which is to say, what are the best sector in real estate should retail investors consider? Residential, commercial, retail, shop lots, office, etc. So I think we had some discussion on it. I think let's just summarize it maybe, Shouting.
Yeah.
Michael, if you can just summarize which is the best sector in real estate before we move on to REITs.
I think it's a combination of choosing sector and location. Earlier means a couple of years back, it used to be commercial that has a higher yield. But recently, industrial properties yielded better. But industrial property, you need to buy, a few million to buy that property. So it's not it's easy to say that retail industrial properties are better, but it costs more to buy. And then every 10 years, the location is dynamic. It goes out of fashion, and then after 10 years, nobody may end up renting that place. So I would say it's a combination of sector and location. Don't choose a current hotspot only, but choose a current and future-ish hotspot. I like near MRT stations, people moving stations, and the future stations coming in. You may not think much about it today, but high traffic flow is one of the important aspects of higher rental return. To you, Rajen.
Michael, actually, what I want to ask you is, because I'm looking at Rahim Ali's question, the one that Malek was talking about. You and I were talking, I was reacting to what you had said about the value of the high-speed link between Malaysia and Singapore. Both you and I mentioned Malacca and Seremban. So just to answer Rahim's question, in terms of actual location, would Malacca and Seremban be very good places to look at?
If anything, 5 kilometers of the station is hot, and its future potential is there. Not only Seremban, but it's a whole corridor, even down up to Johor up to Singapore. I think the southern corridor will do very well with the firm announcement, and then with the station. Even the ECRL coming down, Kelantan, Terengganu, certain areas, of the everything on the east coast of the peninsula, coming down to even to Pahang, they are future hotspots, current future hotspots. We should look at these things, not just everything is centered around the traditional places.
And the huge assumption that high-speed railway is a project that will come on. We don't know that yet for sure.
We hope.
Yeah, I hope you can tell. Over to you, Shou, about REITs. You were talking about REITs before I interrupted you. So sorry.
No, yeah, back to the question about REITs. I mean, Rajen, how should we go about looking at this alternative way to invest in property?
Okay, I love REITs. Remember, I told you brick and mortar. With great expertise, I managed to lose money on brick and mortar property in Damansara Heights. So nobody come to me asking me for brick and mortar advice. But for myself and for my clients, I have actually done very, very well in the REIT space. In the past, I owned every listed REIT in Malaysia. I bought everything. I used no discretion whatsoever, sapud everything. Small positions, but I did that to get every REIT listed on Bursa Malaysia on my radar screen so I could actually look more closely. After looking more closely, I began to distinguish between the wheat and the chaff. And so I began to buy larger positions in the better REITs. I've also invested in S-REITs, Singapore REITs, and Singapore is wonderful as a REIT center. It's great. Lots of REIT companies that don't just focus on the tiny republic nation, but across Asia, they use the Singapore stock market because the S-REIT market is so deep. For my clients, I'm not licensed to give them direct stock advice. I am licensed on the fund side. So for both myself and for my clients, I have placed them very, very productively in a regional REIT fund and also in a global REIT fund. We have a REIT fund within my stable that's managed out of Boston. And the global one in particular, I think is really exciting because if things continue to go south for Malaysia, then one would assume that our currency is not going to do so well for a while. And if that's the case, by being outside, investing outside, particularly if you are not investing in a ringgit hedged fund, if it's actually free floating, then one of the advantages you have is that with currency movements, at the end of every trading day, marked to market investments must be marked to market. You've got to see if the price goes up, that your fund price goes up. If it comes down, the fund price comes down. If a market is flat, but if we have, say, the US dollar strengthening vis-a-vis the ringgit, you end up with actually more ringgit to spend in your local market as well. So I like REITs. From a fund perspective, I would prefer to have internationally diversified REITs. I think those make very good sense. In terms of focusing on where, let's say you have an opportunity working with your advisor or financial planner or whatever, to be able to make quality judgments based on, I can target this particular continent or this particular country, the most important thing to look at would be demographics. For those who are interested, our listeners, our viewers, go do a Google search on what's been happening with Tokyo real estate prices. And, Tokyo historically has had the highest real estate prices per square foot in the world. From what I gather, that may no longer be the case, but please go and check for yourself. Demographically, what has happened is that Japan is the oldest nation in the world. It's aging faster than any other country. And because the Japanese don't allow sufficient immigration into the country, we don't have the numbers. A friend of mine, he's one of my expat clients. I had a meeting with him a week ago. And he told me, I haven't verified this, he just told me that in 2004, there were 120 million Japanese, I think he told me. And now he tells me there are only 105 million. So in just 16 years, for those of you who are fans of Friends, the TV series Friends ran from 94 to 2004. Many of us still watch the reruns. That's pretty much my staple on Netflix right now. Friends stopped in 2004. We're now in 2020. Japan, the country, lost 15 million people. You cannot fight a demographic swell like that. So I concur with Michael's advice. Check out the MRT stations, check out the development, buy close by. But what we need is numbers. And there are many countries, mainly focused in Asia, where demographically our numbers are skyrocketing. And so that's how we should invest if we are choosing a great degree of granularity for REIT investments. In general, not just for REITs, but also all kinds of paper investments, my recommendation always is, in every crisis, become far more miserly with your cash, only buy things of the absolute highest quality. I remember the Asian financial crisis. I was in my early to mid 30s at the time. And as markets collapsed, I had very, very little money to spare, but I had some. And I bought companies, listed companies on Bursa for, in terms of today's pricing, for pennies on the dollar. And that actually helped. But unlike Malek, I didn't buy with margin. Just doesn't match my personality. Malek, I'm sorry, you were going to say something.
Yes, that's right. Because there's a very pertinent question. I'd like us to cover it before I think we're nearing the end of the conversation. To Rajen's point about buying, this is from Vasudevan. It's about to the point of buying multiple REITs. Does it make sense to buy multiple REITs that are in competition with each other? For example, Sun REIT and IGB REIT, for example, right? So REITs in competition. Yeah.
So in the same space.
The same space. The other question I'd like you to address, Rajen, as well. With that, also, is there a particular REIT, sectoral REIT, that you would look at right now versus, for example, retail sector?
Yes.
Versus
there are.
Industrial sector versus even now you have data center REITs, right?
Absolutely.
Yeah. Over to you.
One of my foreign investments has actually done very well. I bought this a really long time ago. Is US Tower REIT. Now, I bought it because I actually did and still subscribe to the Motley Fool investment newsletter. Most of the time, I just skim it. Occasionally, if there is a intersection between free time and having extra money. So anyway, I bought this US REIT a long time ago. Now, interestingly enough, as the world makes a transition from 4G to 5G, the number of cell stations, the towers, will actually have to increase. And so as a direct investor in Tower REIT in the US, I benefited. The global REIT that I was talking about, that I put my clients into, that I put some of my own money into as well, that also has looked at the telecommunication sector, particularly to ride the wave to 5G. So Malek, I'm answering your question directly. The other thing to look at is see who's successful. Richest man in the world, once again, Jeff Bezos, Amazon. And so it's not just Amazon per se, but all the well-run online
e-commerce platforms.
E-commerce platforms are enjoying more and more of us just clicking and buying. And when you click and buy, logistics rises, warehousing rises. So that's very, very important. So I would consider investing in there. The other area that I like would be healthcare REITs for hospitals. Everyone's getting sicker. Everyone's getting far more paranoid. And COVID-19 is not helping us at all. But, if you're in the right space, you do well. I would be very wary of physical retail REITs. So there was a question here. Should we buy multiple REITs in competition with each other, Sun REIT and IGB REIT? Basically, if we get to the space, to the time when the retail sector improves, and I'm sure it will at some stage, then if you've got REITs that focus on retail space, but obviously by definition, different retail spaces, I would have no problems at all. I would buy both. Remember what I said, I bought everything, right? Small positions. And then I would look very closely. And one of the, prior to the lockdown and the border closure with Singapore, I would head down to Singapore every 4 to 6 weeks. And from a personal investment perspective, what I like to do is to basically do my research, as in drive, or actually I don't take the MRT, I would drive and park into a shopping mall, and I'll just walk around, particularly if a REIT that I own runs that mall. And then if I do it a few times, I get a general sense You know, a long, long time ago, many, many decades ago, Warren Buffett, world's greatest investor, the one who just turned 90 years old on August 30th, Buffett used to do that actually. He would go into physical shopping centers and he would walk around and he would measure stuff and he would look at the number of people. So you should enjoy your life. You should enjoy your investment process and learn as much as you possibly can.
All right. On that note, unfortunately, we've kind of run out of time for gentlemen. So thank you for your time today. And joining me on this webinar was Rajen Devadason, licensed financial planner and CEO of RD WealthCreation, and Michael Gay, board member of FIABCI, the International Real Estate Federation, and senior partner of Rain and Home International Zaki and partners in Darren Berhad. We also had, of course, Malek Ali, founder of BFM and filife. Now, meanwhile, the next series of webinars to look forward to is the BFM Enterprise Back to Business Weekly. It's a series of 6 starting from 10th of September, Thursday, 1:30 p.m. So do join us. The first topic is digital transformation during a crisis. In the meantime, thank you for joining us this afternoon. I'm Wong, Ning, BFM 3.9.